with the home prices dropping, we have another question here. Home builder sentiment in the single family home market dropped to half of what it was 6 months ago. Is now a good time to be a developer in commercial real estate? And I would add, in addition to commercial real estate, BTR, build to rent. Is now a good time to be a developer in either commercial or build to rent?
I'll agree with Bob on that. So my industrial assets that I'm building are doing phenomenally well. The vacancy is very low. I'm getting the rents that I want, and cap rates are still very low in that particular market, even though I expect them to decompress. So great time to be building industrial. Now the question from a BTR perspective is mixed. So while sentiment is down, and I know that market well. I have over 500 million invested into the BTR market from the development side, and I can tell you this: I'm still waiting for builders to capitulate. I'm still waiting for landowners to capitulate. When will that happen? I'm guessing it's Q1 or Q2 because I've started to start getting more phone calls from brokers saying, "Hey, there was this piece of land that you chose not to make an offer on. I want to talk with you about it." So my answer is wait for about 3 quarters. There's going to be blood. There's going to be blood in the streets for people that basically paid for land that's basically built to rent land, either for townhomes or single family homes. We're not there yet. So I very carefully follow the big builders. So I read the DR Horton report. I read Lennar. I read Pulte Homes. They're screwed, all of them, but they're not at the point where they're doing fire sales of the land that they put contracts on. And I think that happens Q2, Q3 next year. And that's the trigger for the builders. Because, Lennar doesn't really build anything. They just basically go and pay other people to build it for them. So the local builders that work as subcontracts for Lennar and everyone else. So those people are not hungry yet. Why? Pipeline. Development is a pipeline business. Right now, every builder in the US is busy because they're still developing whatever I paid them to develop last year. It takes a while to get to that point. So my feedback is the end of next year may be a good time to start going to builders. They'll be hungry. They would have paid on pieces of land that they can't build on, and you can strike deals with them to do build to rent. But I think it's early days in that market. It takes a lot of time for that market to adjust.
So a couple of terminology for some questions I've seen coming in. I'm just gonna go ahead and answer these. I'm not familiar with industrial. What does that entail? Industrial is warehouses, like think Amazon, Walmart, major warehouses, as well as last mile, small warehouses that bring you your stuff. So when you buy something on Amazon, it's stored somewhere before it gets to your house. Those buildings that store that stuff, that's industrial. It can include some other niche asset classes like data centers, just big, vast spaces that just house data centers and other unique things like cold storage. But industrial is the general food group for business renting that does not have people coming to an office, manufacturing, storage, data centers, what have you. And what is the difference between traditional multifamily and build to rent? Multifamily is multiple units in one structure. Build to rent is typically referred to and tracks development of single family units. Where you build it not for the purpose of selling the homes to a homeowner, but for the purpose specifically of renting that unit in that particular development. It's just a different grade of quality when you're constructing for build to rent versus selling to a homeowner. Okay, so one of the questions here I think is also getting answered, but I'd like to clarify. So Selva asked, is this a good time to get into land development where the buildable lots will be ready in 2 to 3 years? Neal, you're saying yes, but no. Yes, because it's almost. You're saying in about 6 to 9 months, it will be a good time. I'm seeing the similar data coming from John Burns Consulting where land is becoming less desirable, but I haven't seen the shift in pricing yet being a developer ourselves. So I've got a question for you, Bob, saying that you would like to, or that you are looking at development. Both of you think that this is a good time to develop. We have a peer in the storage group that is doing lots of development, just launching them like crazy. October, November, no problem. He is a merchant builder, and he is taking on, I believe, to be fairly sizable variable rate risk as a merchant builder. So how do you finance this development? Especially in 6 to 9 months, maybe land prices come down faster. If cap rates have only moved a point, but interest rates have moved substantially, and you're taking on this development risk as well as lease up risk where you do not have cash flow along the way, how do you finance these things safely? What is the best strategy for development? And I'm asking this, I wouldn't have asked this, but I saw 7 questions coming about this at the same time.
Well,
And,
my feedback's very similar. Love regional banks, and that's why you need to keep the size of the deal smaller. So you always have to understand your market. So let's say you're investing in New Braunfels, which is 30 miles from San Antonio. You need to know the answer to this question. If there were three banks based in San Antonio, what is the loan amount they're comfortable with? And size your loan to that amount. So do not build a project over that amount. None of them will compete with you. Basically, you'll simply lose all of the local banks. So I've had projects that I've walked away from that were pretty lucrative, where I basically simply couldn't size the project to match the local banks because I'd never want to lose that segment. And all of my, hits in this environment have been local banks. Here's one other tip, which may not work for you, but there's possibly other people listening in here that it might work for. So one of the things that I like to do is that as I'm raising money for value add, properties, often I'll raise funds way in advance. Right now I have millions of dollars sitting in the bank. My investors know I'm not going to buy anything in this quarter. I'm not going to buy anything in Q1, but I will buy something in Q2. And so they're giving me that money knowing that it'll get deployed. Guess what I'm doing? I'm keeping that money in a local bank and getting them to do my construction projects. Local banks love deposits. National banks don't particularly care, but local banks, if you put $10 million or $20 million into a local bank, they will give you incredible construction deals, absolutely crazy rates that may not even make sense to you. It's like, how are they doing that? The answer is they're really sensitive to deposits because that allows them to grow their total lending. So if you have money that basically is simply parked in a bank that you can't really do anything else with, park it with them first, then go ask them for a loan. It makes a huge difference.
Awesome. Thank you both. All right. And just a reminder, if you have more questions as we're having this conversation, be sure to drop them in the Q&A. All right. So we've been talking about financing here a little bit, and we covered this a little bit, but I just want to expand the scope beyond development. What are your thoughts on the continued use of bridge financing and the cost of the rate cap?
I think, Bob, they're going to be rescued, and I'll tell you why. Bridge comes back when interest rates start to drop. My model shows they'll start dropping in Q3 or Q4 of next year. So just as all of these bridge guys who've made crazy deals are hyperventilating, I think they'll start to see bridge again. Remember, bridge doesn't require interest rates to drop. It simply requires the going forward prediction of rates to be that they will go down or stay stable and won't go up. The bridge market only is non-existent as long as people don't know how high rates will go. The moment they know that there's a plateau and there's a chance that they'll go down, the bridge market reappears, though it's going to be pretty expensive. But I'd rather take an expensive bridge loan than lose my property. Yeah. So it really depends on how much you overpaid, right? So some of them will be able to squeeze by or put a little bit more of equity in. I've been talking with a friend of mine about creating a equity fund that basically finds those kinds of properties and comes in as lending to help them basically get their DSCR up. And I get first access to everything on the property. So basically I'm in a senior position to all of the equity. So it's risky, but it's definitely not as risky as all those investors in there.
Seller financing. So I saw a post the other day that the only way to get deals done is to buy cash, loan assumptions, and seller financing. So if I can get a seller to the table to say, you know what, I'll give you 40% leverage because that is what I do not have leveraged on my side. And I will do it for you at a 3% interest rate, all I owe for 5 years. The value of that, I would like you to put into additional basis. So if I'm going to be saving $1 million a year in interest expense relative to what I could get with the market over a 5-year period, I would like you to take $5 million and add it to the basis, or better yet, I'd like you to take the discounted cash flow value of that 5-year interest rate delta, let's call it $3 million, and add that to your basis. Is that smart? Is that wise? Can you pay more for lower interest rate seller financing?
I think it's an Excel question, but I'd say I want to have a way to exit them. So that's the only thing that I'll add to that. I don't want them to be there until the very end. If the market improves, I want to have a way to exit them.
Well, thank you for validating my current strategy. So I appreciate that was a bit of a selfish question. So let's chew around the edges of some of these outstanding questions that we have here, guys. And for those of you who are giving us a what's up and a thumbs up, much appreciated. Omar, hey, what's up? This session is way more beneficial than I expected. I learned more than I thought I would. Thank you, Mark. This is the type of content that we like to provide at Best Ever. We have nothing to sell. It's just a lot of fun to hang out with Neal and Bob, put Hunter Thompson and John Chang on the screen, and I don't know that you get a better room than that. So here's another question I have from on. What type of accounts do you suggest investors save money in until ready to be used for real estate syndications and investments if our cash is losing value to inflation in regular checking savings accounts, but we want our cash to be accessible when ready to invest?
The answer is Comerica. Comerica has money market accounts. I get 3.6% today. Anyone can call. Call Comerica. These are money market accounts. They're 30-day liquid, and they do not put that money into stocks or bonds. What they do is, and I have tens of millions of dollars with them, and that actually it's paying for that entire side project is being paid for with $3.6 million on 50 plus million. So it's an amazing product, and I think that you should look at it. They actually break it up into $249,000 chunks and put them at different banks. Why 249? Because 250,000 is FDIC insured. So they put them at different banks, and they give you a list of all the banks that they're spreading this money out to. So check it out. Comerica Money Market, 3.6% as of last week.
Hot
And it's
tip.
going to go up to 4.1, by the way. It's going to go up to 4.1 on December 6th because the Fed's going to raise by 50 basis points and Comerica is going to raise it by 45 basis points, with that last 10 bips obviously being their spread.
And Marcus is offering same day liquidity at 3%, which is a Goldman Sachs bank. Barclays Capital has something similar. I think Capital One. So we are starting to see savings rates above 3%.
I see a question. So no, spelled Comerica, 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 not Coal America. Comerica.
Yeah. All right. So we got one or two more here. We're just going to bang through them really fast. Why sell? Another question for Mark. Why sell when the rate is at its lowest? Would you mean things are kind of crazy during a recession, so you don't want to sell? This was during your presentation, Neal. So this was at the end of your presentation. You made a comment. Why sell when the rate is at its lowest? You had said when things are kind of crazy during a recession, so you don't want to sell. I don't know if you recall the comment.
Well, during a recession, firstly, it's not a great time to sell. So I simply won't sell until there's bullish people in the marketplace. So I'll just hold. So my goal is do not sell any asset from now until June 2024. I build detailed models and I shared it in my presentation. And I change those models every month. By the way, one thing I'm not looking to predict the marketplace. I'm looking to learn from it and change, because one thing I know is I'm always wrong. But if I keep listening to the market every month and changing my model, then I have a good shot of being right at the end. So the short answer is I'm not looking to sell. So if I implied that was incorrect. I'm looking to hold every asset that I can until June 2024.
Awesome. Thank you for that, Neal. So let's hit one more topic while we're here. Demographics. At the end of the day, that's still a huge issue. It doesn't matter if you're in a recession or not. If you're investing in commercial real estate, you need to be paying attention. So what are you guys looking for in the demographic data? You've alluded to some that core markets are a little bit scarier now than secondary markets, but what other demographic trends are kind of your guiding lights right now?
A different, feel for us. So I also like high income markets. For example, I'd take New Braunfels, which is a small town, over San Antonio, even though San Antonio is a much larger market, because New Braunfels $20,000 higher income on average. So I tend to, it's easier to get rents and rent inflation there. But I am extremely, massively, extraordinarily worried about demographics in the United States. The world demographics are truly effed. But the US demographics, while being one of the strongest in the world, are still problematic. So, the population growth in the last 2 years has been 0.2%. It's kind of hard to keep long-term inflation up when your population growth is slowing. And that's why I'm afraid of the Midwest. I think the best deals are in the Midwest. And if you know what you're doing, you can make lots of money. But, for larger projects, especially new construction projects that I feel are riskier, I'm just very obsessed with going into markets with extraordinary population growth. I'm looking for 5 times to 10 times the US average, 5x to 10x the US average, because I'm really worried about what demographics do to real estate prices in the 26, 27, basically 3 or 4 years from now, when everyone realizes, oh shit, we don't need as much housing anymore because the country's demographics are so negative.
So once again, I'm going to ask a selfish question that has nothing to do with the topics that we're talking about today. And this is something that's 50 years out. But here's a question that I have for you two gentlemen. Can capitalism survive as a primary structure for society if we do not have global population growth? If 50 years from now we have population decline, can capitalism survive? I'm just curious, a little waxing poetic here.
I have a slightly different answer. I mean, a very, very similar thought process there, but I like to look at Japan. So obviously Japan, negative population growth for decades. And what the Japanese did was restructured their society, number one, to serve older people. And number two, they became an export society. So they basically started looking at fast growth nations such as India or in the African area. I think they're very strong on Nigeria, and basically became a service economy to these fast growing nations. So the US is extremely nimble. I find us that no other country in the world is as nimble from a capitalistic perspective than the US is. And we'll basically find fast growing economies. The entire world's population is not going to slow down at the same time. The African continent, if they can stay away from wars, are actually going to have a phenomenal population growth over the next 50 to 100 years. So we can attach ourselves to them. The second part of it is technology is going to help. So one of the best ways in which you can actually thrive in an environment where population doesn't grow is if less people die. Life extension technologies are just starting and will have a phenomenal 30-year run. I fundamentally believe that for affluent people, you'll be able to extend their life by 25 to 30 years. When you do that, you overcome the effect of population loss because that person is now living another 30 years. Right. And in the past, they would have simply died. So no services would be needed. No goods would need to be sold.
Yeah. But are they
Well,
working?
the question is, right. So, how much will they produce?
GDP,
Right.
so
They don't. So I think we need robotics to help. Right. So I think what will happen is we're very uneven kind of problems, that we will create of, where are all the people that we need to sell goods to? And then all of a sudden, well, we have these older people, but then who's going to provide the services? Well, now we need robotics and we need automation. So it's going to be extremely bumpy. But I think what happens is technology tends to fill in the gap. So you ask technology the question of where are all the people? The answer is life extension. And the question is, well, who's going to provide the actual services? Who's going to make my hamburger? The answer is, my family owns 115 Burger Kings, and they're now installing their first completely automated Burger King where the burgers are made by a machine, right? So that's a process, and it doesn't happen until it becomes really, really expensive. But have you noticed labor costs are going crazy? So that's when automation really starts to happen and take effect. And I think automated driving over the next 15 or 20 years is also going to put about 10, 15 million people out of work. And I think they can be put to work doing other things.
That's some good Socratic conversation. So we actually have a question that came out of this conversation. So as a passive investor, what periodicals should I be reading to keep my finger on the pulse of the real estate market? What do you read? What do you subscribe to? And Neal, I know you kind of answered this a little bit. You kind of put up a QR code to find out, but maybe just hit the highlights.
Well, I think that QR code will help you, look at sort of what I'm reading. But I think the one thing that I like to do, which is really easy to do, is I go into Flipboard, and every time I read a real estate article that I like, I do not forget the one important thing. I thumb it up. So what happens over time is that as I like articles of different kinds, real estate demographics, multifamily cap rates, self-storage, things like that, I keep thumbing them up. And over time, Flipboard for free does the job of basically bringing the more and more articles in. So that's kind of a cheating tip for you. I've been doing that thumbing up for 3 or 4 years. And now more than 50% of all content that comes into Flipboard every day for me is somehow real estate related. So I think that's key. The other one that I'd like to propose for people that are multifamily folks is Yardi Matrix. I think that I have to give them, kudos. Their monthly newsletter, which comes into my email, and their quarterly webinars are absolutely phenomenal in terms of understanding what's happening in the space. So if there's one that you should sign up for the multifamily space, it's Yardi Matrix. I actually have a friend that forwards me all of the Goldman Sachs write-ups. He's got it set up on auto, so it comes in his mailbox and then comes into my mailbox a few seconds later. Amazing stuff, right? These guys are like way beyond our capabilities.
So we have another question that's coming here. We did not touch on assisted living, housing, and pharmaceutical assets. You guys have opinions on those?
I've been very bearish on assisted living before COVID, and for different reasons, because I love the fact that in multifamily, we all hyperventilate when occupancy falls from 96 to 95. Oh my God, the sky is falling. I mean, their occupancy hasn't hit 90 for the last 7 years. I mean, and that had nothing to do with COVID. I mean, It's people are converting 5-bedroom homes into assisted living.
That's right.
So they're basically, there's a supply side issue on the assisted living side that we haven't seen on the multifamily side, right? So there's a real problem there. Please go look at the occupancy rates for assisted living for the last 6 or 7 years. It's a real problem. And then of course, this COVID thing is a double whammy. I mean, there's a bunch of people that do not want to go live in those places. And I think, even though I don't think it makes any logical sense, I think COVID's really gone at this point in time, but mentally they've been affected, and God knows when they're going to snap back to saying it doesn't matter. What about 55 plus? I love 55 plus because assisted living is a hotel inside a hospital. Well, 55 plus is neither a hotel or a hospital. So I think 55 plus adult, especially in affluent markets, is something to really, really look at. They were very expensive. They were selling for ridiculous prices, in 2021. So I just stayed away. But I think that once the market corrects and you see something reasonable, I think that 55 plus in affluent markets, B, A minus kind of assets, I think that's amazing because you get all of the benefits on the assisted living side. You get older tenants that stay for a longer time, but you're not really dealing with all the legal and the legislation to, feed them and make sure that they get drugs. None of that's happening with 55 plus, even though people say 55 plus, but do you know that the average tenant in a 55 plus community is almost 70 years old? So you get all the benefits, you get none of the downsides.
Let's just round out the asset classes here. Mobile homes and accessory dwelling units in places like Los Angeles. Thoughts on those?
I like mobile homes. I just don't invest in them because they're so time intensive and they don't scale well. That's a challenge with mobile homes. They don't scale well. But I think for somebody that's starting out, it's certainly something to look at. Keep in mind that mobile homes tend to have delinquency problems during recession. So you may not want to buy one until the end of a recession, but you'll get really good prices at the end of a recession because there would have been 6 or 9 months of delinquency already affecting their net operating income, therefore affecting their prices. So maybe at the end of the upcoming recession would be a great time to buy a mobile home park. I just find that it doesn't scale well.
There are folks who are getting the entitlements on behalf of homeowners and then taking a part of the ownership of the ADU at scale, hundreds. I think
It's
I don't know if there's
painful.
anybody past
It's
100.
painful.